Level 1, 450A 450 credit score. You know the number without opening the app because it follows you everywhere. Into the car dealership, into the apartment application, into the bank, into every conversation that includes the words, "We just need to check your credit." At 450, that sentence never feels routine. It feels like a warning. Because you already know what they are about to see. Collections, charge-offs, missed payments, maxed out cards, maybe a repossession, maybe accounts you stopped checking because opening the report started feeling worse than ignoring it. The lender does not see the job you finally found. They do not see that the medical emergency was 2 years ago. They do not see that you are trying to rebuild your life. They see the file, and the file says risk. At the dealership, the salesperson is friendly until the credit application comes back. Then the conversation changes. The car you wanted suddenly becomes difficult. The payment you expected suddenly becomes impossible. The down payment becomes $5,000, then $7,000. Then they ask whether somebody can co-sign. And eventually, they show you a different car. Older, higher mileage. More expensive than it should be. But they tell you that this is the vehicle the bank approved. At this level, you do not choose the car. The approval chooses it for you. Q1 2026 averages show deep subprime borrowers paying roughly 16.01% on new vehicles and 21.77% on used vehicles. That does not mean every 450 borrower receives those exact rates, but it shows how expensive low-score financing can become. Credit cards are not much better. The options are usually secured cards, subprime cards, small limits, annual fees, and interest rates that make carrying a balance dangerous. You might put down $300 to receive a $300 credit limit. You are giving the bank your own money so it can begin trusting you again. A home approval feels far away. A good personal loan feels far away. Business funding feels like something that happens to other people. At 450, credit does not give you convenience. It gives you restrictions. The first rule of 450, you are not shopping for the best approval. You are trying to escape the most expensive level of the system. Level 2, 530A 530 credit score. You are no longer at the absolute bottom. And that sounds like progress. The dangerous part is that lenders may begin saying yes. Not a clean yes, a conditional yes. Yes, but the rate is high. Yes, but you need a large down payment. Yes, but the limit is only $500. Yes, but the annual fee starts immediately. Yes, but you need a cosigner. Yes, but not for the car you originally wanted. At 530, the door does not stay completely closed. It opens just wide enough for an expensive deal to fit through. And when you have heard denied enough times, even a bad approval can feel like victory. You hear, "Congratulations, we got you approved." You stop listening after the word approved. You do not hear the 72-month term. You do not hear the interest rate. You do not notice the warranty rolled into the loan. You do not calculate what the car will cost after 6 years. You only feel relief. But relief can be expensive. Current market averages place the broader subprime category at approximately 13.44% on new auto loans and 19.42% on used auto loans. Again, your exact offer may be higher or lower depending on your full profile. At this level, secured cards and credit-building products become more realistic. A starter unsecured card may appear. The limit may still be low. The APR may still be high. The bank is no longer refusing to know you. It is watching you carefully. One missed payment can push you backward. One maxed out card can erase months of progress. 5 unnecessary applications can make the report look desperate again. This level is not about getting premium rewards. It is about proving consistency, paying every account on time, keeping reported balances low, stopping random applications, reviewing the negative information that is still holding the file down. The second rule of 530, you can finally get approvals, but the wrong approval can keep you poor longer than a denial would. Level 3, 610A 610 credit score. Life begins looking normal from the outside. You may qualify for a basic credit card. You may get approved for an apartment. You may finance a car without needing a miracle. You may receive loan offers in the mail. For the first time, the credit system does not reject you everywhere you go. But 610 is fragile. It is the credit score version of living paycheck to paycheck. Everything looks stable until one problem arrives. You can get approved. You just do not get approved cheaply. Average near-prime auto loan APRs in Q1 2026 were approximately 9.67% for new cars and 14.03% for used cars. On a large loan over several years, that difference can quietly become thousands of dollars. A mortgage is still difficult. The CFPB says borrowers below 620 generally have trouble qualifying for a home loan, although the final decision depends on the lender, loan program, income, debt, down payment, and complete credit history. At 610, you are close enough to normal to become impatient. You see people getting rewards cards. You see people buying homes. You see people walking into dealerships with bank pre-approvals. You think you are almost there. So you begin applying. One card, then another, then a personal loan. Then the dealership sends your application to several lenders. The inquiries stack, the score falls, and suddenly you are back below 600 wondering what happened. At this level, the report still matters more than your confidence. A 610 score with one old collection is different from a 610 with 5 recent charge-offs. A 610 with 5% utilization is different from a 610 with every card maxed out. The same number can tell 2 completely different stories. The third rule of 610, you are no longer invisible to lenders, but you are still being priced like someone they do not completely trust. Level 4, 660A 660 credit score. The pressure becomes quieter, not gone. Quieter, you no longer expect every application to end in embarrassment. A car approval becomes realistic. A basic rewards card becomes possible. An apartment application feels less threatening. A personal loan may come back with terms you can at least consider. You have options now. But the options are not always good. A score around 660 sits near the line between near prime and prime auto financing. One lender may treat you like someone moving upward. Another may still treat you like risk. One bureau might show 660. Another might show 635. The auto lender might use an industry-specific score you have never seen. That is when you learn an important lesson. You do not have one credit score. Different lenders may use different scoring models, different credit bureaus, and different versions of your score. Home ownership may become possible, but not necessarily inexpensive. The CFPB says borrowers in roughly the 620-680 range often face the highest mortgage rates and the fewest choices, although government-backed programs may offer additional paths for qualified borrowers. This is where many people relax too early. They receive a $3,000 limit and spend $2,700. They qualify for a car and buy more car than their income can support. They see the score rising and assume one late payment will not matter. But 660 is not permanent safety. It is an opportunity. Your credit has started giving you room. What you do with that room determines whether you move towards 700 or return to 600. The fourth rule of 660. Credit begins giving you choices, but discipline decides whether those choices become freedom or new debt. Level 5, 700 700 credit score. This is the number people like saying out loud. My score is around 700. It feels respectable. It feels like proof that the old version of your financial life is disappearing. At 700, you were inside FICO's good range. Banks begin treating your application as a normal opportunity instead of an emergency risk review. Auto financing becomes noticeably better. You are now inside the broader prime auto tier, where Q1 2026 averages were approximately 6.23% for new cars and 8.77% for used cars. Your actual offer still depends on income, debt, vehicle, term, and down payment, but you are no longer automatically paying subprime prices. The conversation at the dealership changes. At 530, you asked, "Can you get me approved?" At 700, you can begin asking, "Can you beat my bank?" That is a different position. Mainstream cashback and rewards cards become more realistic. Better limits become possible. 0% introductory offers may begin appearing. Balance transfer offers may arrive. You may qualify for cards that offer real value instead of charging you simply for being accepted. Homeownership also becomes more realistic. But 700 is not necessarily the best mortgage tier. You may receive a decent offer while someone with a score in the upper 700s receives a lower rate on the same loan. That small difference feels insignificant on the day you sign. Over 30 years, it does not stay small. At 700, the greatest danger is confidence. You finally feel safe, so you apply more, spend more, finance more. A high credit limit begins feeling like extra income. But a $15,000 limit does not mean you earned $15,000. It means the lender trusts you with $15,000. Trust and income are not the same thing. The fifth rule of 700, banks finally respect your file, but respect is not yet the same as having leverage over them. Level 6, 730 730 credit score. Now the system begins working with you instead of constantly working against you. Approvals feel less random. Offers become more useful. Credit limits can become larger. The language inside the emails changes from build your credit to earn rewards. That small change tells you everything. At 730, you are near the top of the FICO Good category. Mainstream rewards cards such as Chase Freedom Unlimited, Citi Double Cash, American Express Blue Cash every day. And Capital One Savers style products may become realistic targets for a strong overall profile. Some borrowers may also become competitive for travel products such as Chase Sapphire Preferred, depending on income, debt, recent accounts, inquiries, and the issuer's internal rules. The cards currently exist, but none publishes a universal score that guarantees approval. That last part matters. A 730 score does not make approval automatic. A 730 with a thin 6-month history is different from a 730 with 10 years of perfect payments. A 730 with one recent charge-off is different from a clean 730. A 730 with 15 recent applications is different from a 730 with 2 inquiries. The score gets you considered. The complete profile gets you approved. This is why pre-qualification becomes useful. Many issuers allow you to check potential offers using a soft inquiry, but pre-qualification still does not guarantee final approval. At 730, car shopping becomes more comfortable. You can get pre-approved before entering the dealership. You can compare lenders. You can reject a bad rate. You can focus on the total cost instead of celebrating that somebody said yes. The mortgage conversation also improves, although the lowest rates are generally reserved for borrowers in the mid to high 700s and above. This is the first level where you stop chasing approvals. You begin selecting them. The sixth rule of 730, your credit no longer asks for permission. It begins giving you options. Level 7, 760A 760 credit score. Credit becomes quiet. You do not check the score every morning. You do not panic before an application. You do not walk into the dealership hoping the finance manager can save you. You arrive with your own financing. You know your rate. You know your budget. You know that you can leave. That ability to leave is the real benefit of good credit. At 760, you are inside FICO's very good range. You look dependable to lenders, not perfect. Dependable mortgage pricing becomes much more competitive. The CFPB says the lowest home loan interest rates generally go to borrowers with scores in the mid to high 700s or above, and those borrowers usually have the greatest number of choices. Premium travel and rewards cards become more realistic. Higher limits become more realistic. Strong balance transfer offers become more realistic. Business credit conversations become easier, not guaranteed. Easier. At 5:30, the bank asked, "How do we protect ourselves from this borrower?" At 760, the bank begins asking, "How do we win this borrower's business?" That is the shift. A lower auto loan rate leaves more money in your account. A better mortgage rate leaves more money in your account. Better rewards return some money you were already spending. Higher limits can make low utilization easier to maintain. The advantages begin reinforcing one another. Better credit lowers costs. Lower costs help you save. More savings makes your full financial profile stronger. A stronger profile earns better offers. This is the cycle you were trying to reach. But 760 is not untouchable. One missed payment can still hurt. Maxing out several cards can still cause a major temporary drop. Identity theft can still damage the report. A collection reported by mistake can still interrupt a mortgage application. At this level, the job is no longer rebuilding. It is protecting. The seventh rule of 760. Credit stops being a survival tool and becomes financial leverage. Level 8, 810 and 810 credit score. Exceptional, not because the number makes you wealthy. Because the file tells lenders that lending to you is unusually low risk. At 810, credit works quietly in the background. You apply less often. When you do apply, approval feels expected rather than miraculous. A denial would surprise you. At 450, an approval surprised you. That is how far the experience has changed. In the auto market, scores from 781 to 850 fall into the super prime tier. Q1 2026 averages were approximately 4.55% on new car loans and 6.30% on used car loans. That does not mean an 810 score guarantees those rates, but it places you in the strongest average pricing category. The dealership sees someone banks want. Mortgage lenders compete. Card issuers offer premium products. Higher limits become more likely. Your decisions are no longer about whether you can get a card. They are about which card fits the strategy. Cashback, travel points, airport access, purchase protection. Business expenses, no annual fee, premium service. The card itself is not the achievement. The ability to reject it is. At 810, you can reject the wrong loan, reject the overpriced car, reject the weak mortgage offer, reject the card that does not provide enough value. Bad credit removes choices. Exceptional credit creates them. But an 810 score still does not replace income. It does not erase existing debt. It does not make an unaffordable home affordable. It does not force every bank to approve you. Lenders still consider income, total debt, assets, down payment, employment, recent credit activity, and their own policies. The number does not make you financially intelligent. It simply stops the credit system from charging you as though you were financially dangerous. The 8th rule of 8 in 1. You are no longer asking banks to take a chance on you. Banks are competing for the chance to do business with you. At 4:50, you take whatever approval survives. At 5:30, you celebrate a yes before understanding its price. At 6:10, you begin returning to normal. At 6:60, you gain cautious opportunity. At 700, lenders respect your file. At 7:30, you begin choosing offers. At 7:60, you gain leverage. At 8:10, lenders compete. But the most important part is not the number. It is what the number changes. The car you can buy, the rate you receive, the down payment you need, the apartment that accepts you, the home loan you qualify for, the credit cards available to you, the amount of your income that stays in your own pocket. And sometimes the person sitting at 450 is no longer the person who created that report. They have a better job now. They pay everything on time now. They manage money differently now. But the old damage is still speaking for them. A collection from 3 years ago. A charge-off with the wrong balance. A payment reported late when it was paid on time. An account that does not belong to them. Duplicate reporting. Outdated personal information. An unauthorized inquiry. Errors on a credit report can unfairly lower a score, raise borrowing costs, or cause a denial, which is why the CFPB recommends checking reports and correcting mistakes before applying for major financing. That is where rebuilding begins, not with another application, with the report. Check Experian, check TransUnion, check Equifax, identify what is accurate, identify what is questionable. Dispute genuine inaccuracies. Lower utilization. Stop applying blindly. Build positive payment history. Protect every clean month. Because your credit score does not define your value as a person, but it can decide how expensive your life becomes. And when bad credit keeps charging you poor person prices, fix the file before you finance the next chapter of your life.